In 2020, Hertz declared bankruptcy and sent thousands of cars into the used market. A friend of mine walked away with a low-mileage Mercedes for less than the price of a new Corolla. That story isn't just a lucky one-off, it's a window into what's possible when brands crumble. With Rivian's losses mounting and Fisker's servers literally shutting their cars down, this could be the biggest used car shakeup since the last recession. The question is, are you ready to take advantage? Before we move on, I will like you to subscribe to the channel and like the video. What happens when a company that raised billions to redefine the future ends up burning through more than $2 billion instead? You get a situation that's starting to look a lot like Rivian's current reality. Just a couple of years ago, it was the poster child of EV innovation, backed by huge investment and a long line of pre-orders. Last quarter, they still moved 10,000 vehicles, which sounds impressive until you see that figure is actually 22% lower than the same time last year. That's not the direction investors were hoping for, especially when the financial losses are getting bigger, not smaller. A lot of that red ink comes from places you might not expect. Yes, sales slowing hurts, but the company is also paying more for critical materials. Lithium, nickel, and cobalt have all jumped in price, and new tariffs on rare metals from certain countries are adding extra costs per vehicle. On top of that, tax credits that made buyers more eager to pull the trigger aren't bringing in as much demand as before. It's the kind of triple hit that turns a challenging year into a dangerous one. When a company's quarterly reports keep showing these deep losses, turning the ship around becomes much harder. In the EV market, history is full of examples where brands tried to claw their way back but couldn't. Overhead costs pile up, debt payments loom larger, and investor patience runs out. Look at Fisker, a name that once had a devoted fan base. When it went under, investors saw their money wiped out, and the owners of those sleek electric cars faced a bizarre and expensive problem. Some models literally stopped functioning properly because the company's servers went offline. That's not just a hit to your bank account, that's a paperweight in your driveway. It's why comparisons to larger automakers can be revealing. Toyota recently saw its profit drop by 37%, a huge percentage, but it still earned billions overall and even managed to sell more cars than before. That scale gives them breathing room. They can weather a bad year without fearing complete collapse. Young EV companies don't have that cushion. When they're built around a capital-light model, leaning heavily on software and outsourcing production, it's easy for investor optimism to run far ahead of actual manufacturing reality. But software margins don't save you when physical materials and assembly lines cost more than expected. This creates a classic doom loop. Sales soften, which makes raising new funds harder. That leads to cost-cutting in areas customers notice. Fewer service centers, slower updates, reduced support, which in turn drives more people away from the brand. The smaller the customer base gets, the harder it is to convince anyone new to take a risk on buying their cars at full price. And in the background, creditors and investors start looking at what can be sold to recover losses. That's where the opportunity starts to show. When a manufacturer can't sustain operations, it may need to liquidate assets. That often includes brand new or lightly used vehicles, sometimes still under warranty, being sold at far below normal prices just to clear them from storage. For buyers who understand the risks, like parts shortages or software support ending, these situations can mean getting a vehicle for a fraction of its usual market value. But what happens when it's not just the automakers that collapse, but also the networks and systems those cars depend on? When entire charging infrastructure shut down, even the best bargain car can become useless overnight. That's where things start to impact not just owners, but an entire segment of the EV landscape. How does a charging network vanish overnight, leaving every investment in it instantly useless? That's exactly what drivers saw when Shell pulled the plug on Volta's EV charging stations and its entire media division. One day, the network's illuminated ad displays and stalls were active in store parking lots across the country. The next, they were gone. That shuttering wasn't the result of a technical breakdown. It was a business decision triggered by a model that simply couldn't sustain itself. Volta had built its network around an ad-supported concept. Companies paid for screen space, and in theory, that revenue was meant to cover costs of keeping the chargers free or low cost for drivers. But the math didn't work out. Many chargers weren't fast enough to justify high advertising rates, driver traffic was inconsistent, and maintaining the physical equipment wasn't cheap. When low usage meets high high operating expenses, investors have a hard time seeing a path to profit. This isn't unique to Volta. Early EV infrastructure projects, especially those offering public charging, often struggle to make money. Hardware installation is expensive, utility rates fluctuate, and a relatively small EV population compared to the massive base of gas-powered cars means the customer pool is smaller than optimistic projections assumed. That creates wide gaps between where infrastructure actually exists and where drivers need it most, forcing many owners to plan routes around the few viable stations they can find. We've also seen how hype without readiness can damage public confidence. Tesla's robo-taxi project promised a hands-free ride-sharing revolution, but waves of legal obstacles and technological delays have chipped away at that image. When promises outpace reality, stock prices react and owner trust can erode in the process. This matters because EV buyers often count on a brand's long-term stability for ongoing updates, warranty work, and part availability. If that stability is questioned, even for a market leader, it makes the broader public more hesitant about betting on new technology. When major charging networks or technology pipelines shut down, the fallout for consumers is immediate. A charging location disappearing means longer detours, more time waiting for limited spots, and in some cases, complete inability to use an EV in certain areas. Parts shortages start small, maybe a delayed delivery here or there, but they can grow into months-long waits if a company stops producing or shipping critical components. And when the market senses a model is hard to maintain, resale values can plummet quickly, leaving owners stuck with rapidly depreciating assets. A similar dynamic unfolded in the rental industry when Hertz filed for bankruptcy. The company had to unload portions of its fleet fast, so cars that would normally fetch high resale prices, both economical sedans and luxury models, hit auctions and lots at steep discounts. That swift liquidation gave some buyers incredible short-term wins, but those deals came with strings attached. Many cars had high mileage from constant use, warranties were near expiration, and some required brand-specific servicing that could get costly if the model was discontinued or parts were scarce. That's the trade-off with too good to be true pricing when brands or their support systems collapse. The savings are real, but so are the risks. You might pay half the sticker price on a nearly new EV, only to find reliable charging is harder to find, or a vital repair is far more expensive than you planned. What makes these situations compelling is that they don't just reshape prices, they change how ownership works altogether. Spotting an opportunity is one thing, but knowing how to keep that bargain running without the safety net of a healthy brand or network is where the challenge really begins. And that balance between short-term gains and long-term realities is what ultimately determines if a collapse turns into your best deal or your biggest headache. When an automaker or charging network unravels, it doesn't just shake investor confidence, it changes the entire used car market within days. Cars that were out of reach can suddenly be priced like budget commuters, but the flip side is higher ownership risk. The truth is, your next great deal might not come from a dealership lot at all. It could appear in the immediate aftermath of a brand's collapse.